Welcome to Illuminati Silver. It's Thursday, the 4th of November, 2021 at 09:20 a.m. GMT +1. The weather today is surprisingly good. Yes, having come from West Wales, coming back from holiday, where it poured with rain for 2 of the days that we were there, we have now come back to the land of sun and clear blue skies. And what a sight to behold! However, are the skies clear and blue as far as the news is concerned? Well, not according to the main headline. Carbon levels are rising again after brief COVID drop. This is all about climate change, of course. But we're focusing today on the Fed and what it announced yesterday, because that, in terms of imminence, is more important. We can debate the long-term issues of climate change again. But the other headlines here first, before we look at the Fed. Bank of England grapples with how quick to act on inflation. Yes, the Bank of England today is going to announce its interest rate decision and its QE plans, if any. And that will be in a few hours' time. So, according to Reuters, stocks rise as Fed tapers without tantrums. Bank of England takes the stage. Now, before we look at this, we will say we listened to Fed Chair Jerome Powell yesterday at his press conference, and we felt that he managed a pretty neat trick. He's introduced tapering, and we'll go into that in detail, while at the same time leaving the gate open for him to walk through if he needs to stop it. In other words, he's dealing with the tapering broadly on a month-by-month basis. Very interesting approach. Markets firmed on Thursday after the United States Federal Reserve engineered an orderly start to unwinding its massive stimulus program, though doubts about the inflation outlook did push up longer-dated bond yields. Remember that tapering is not tightening, said Kerry Craig, global market strategist at JP Morgan Asset Management, noting the Fed's balance sheet would still expand by around $400 billion over the next 8 months. This is still a very accommodative policy environment, and one that will support the growth outlook in the quarters ahead and the performance of risk assets like equities and credit. Anxious eyes now turn to the Bank of England, which may kick off a rate hike cycle later in the day, with uncertain implications for debt markets globally. For now, equity investors were content that the Fed was in no rush to remove the policy punch bowl, and Nasdaq futures rose 0.2% to another record high. If sustained, it would be the 9th straight session of gains. And if we look at what the BBC have had to say, the Federal Reserve has outlined plans to withdraw the billions of dollars it has been pumping into the economy during the pandemic. Since the start of the COVID crisis, the US central bank has been buying $120 billion worth of bonds every month to help keep borrowing costs low. Fed Chair Jerome Powell said he expected economic growth to strengthen over the rest of the year. However, he said the Fed can be patient about raising interest rates. The Fed's purchases of treasuries and mortgage-backed securities would be scaled back by $15 billion this month, Mr. Powell said following a 2-day meeting of the committee which sets Fed policy, which is the FOMC. The US economy has rebounded as the vaccine rollout has allowed shops, restaurants, schools and workplaces to reopen, but supply chain difficulties and staff shortages have meant that businesses are struggling to meet growing demand, and prices have been rising at their highest rate for 30 years. Mr. Powell said there had been sizable price increases in some sectors, with inflation at 4.4% in September, running well above the Fed's 2% goal. Now, interestingly, of that 15 billion, and I'm going by memory, I understand that 10 billion of the tapering will be on the treasuries and 5 billion on the mortgage-backed securities. But the important thing to bear in mind, as was mentioned in the previous article, this is still accommodative QE, because although he's tapering 15 billion, that still means that the Fed is going to buy 105 billion. Difference between 105 and 15 is 120. 105 billion a month for the time being. But listening to the conference yesterday, he did give himself the ability to change tack at any time, and they will be looking at this on a month-by-month basis. But he did add that this tapering will take effect for November and December, and then when the FOMC meets again, it will take a view then about the following month. Very clever, neat trick to not upset the equity markets, which was their main goal. In the UK, BBC News, pressure on Bank of England to hike interest rates. We're going to get that later today. Looking at the dollar, it's up 0.35 at 94.2, now rising above that crucial 94 level. We still think, despite the accommodative stance, it could rise further unless, of course, the Bank of England today raises rates, and you might see a slight dip in that dollar index. Not significantly, but you might, if the BOE raises rates. Oil prices, though, are up. Broadly, $0.50 for WTI crude and $1 for Brent crude. Equity markets rose yesterday. The Nasdaq as high as 1%, just over 0.25% for the Dow and just over half for the S&P. Asia Pacific markets all broadly up around 1%, and UK and European markets broadly up 0.25% to 0.5%. Now, the economic calendar, and this is quite important. We had the ADP employment report yesterday, which actually showed an increase against expectations, but a decrease against the preceding month in terms of employment, an extra 517,000 jobs. That's for October. In September it's 523, but expectations are 395, so it is positive. The market manufacturing PMI, higher than expectations and higher than the previous month. And the ISM services index, higher considerably than expectations and the previous month. So this is giving a very strong positive indication of what's happening in the service sector. Factory orders as per expectations, but down compared to the previous month. Now today we have the initial jobless claims, and we're looking at around 275,000. We shall see if that is the case. We have the international trade deficit and productivity. Unless the jobless claims are completely out of sync, then frankly we're not going to see much major response to any of these figures announced today. However, tomorrow we have the non-farm payrolls and consumer credit, and that will give a little fillip to the marketplace, either positively or negatively. Having said that, the price of gold is actually down $7 at $17.75, which is interesting, but it is off its low for the day, which was as low as $17.60. So the Fed, not coming in too hawkish, has dampened gold and silver prices, or gold prices more, not so much silver, we'll see in a second, has dampened gold prices slightly but not significantly. And as I suggested, silver is actually up 5 cents at $23.64, but it hasn't recovered its earlier gains earlier in the week when it was above $24. How do we see it going from here? Frankly, we think we're going to wait for the non-farm payrolls tomorrow. But even if they are a little bit sort of awry, the markets are going to try and settle now because it knows what the Fed is going to do, at least for the next 2 months. However, the decision in December at their meeting, again we will see some trepidation. Cryptocurrency markets down overnight, but still with a market cap of $2.71 trillion. And Bitcoin now standing at 61,623. That's it for now. On the weekend, we'll give a much more in-depth appreciation, and we'll have a good guide as to how the markets are actually responding to Fed Chair Jerome Powell. Frankly, there should be a little bit of a tailwind behind gold and silver prices after yesterday's performance. Even though the tapering has come in, it's extremely mild. And we may see that happen, especially if the Bank of England raises rates today. Thank you so much for listening. Please give us a thumbs up, subscribe, press the bell sign. Until tomorrow. Illuminati silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.